Daily Fiscal Pulse for the 23rd of July, 2026. We're looking at Thursday's session here. These are settled figures, not real-time data, so keep that context as we dig through the numbers. Let's start with what's capturing market attention right now. The AI and technology space is dominating the conversation. You're seeing headlines move around dodge subpoenas of NY Times reporters, with Google also in the crosshairs, and that's clearly shaping how traders are positioning. But narratives change quickly. The actual flows tend to be a better read of what's really happening. Turning to fiscal activity, the net transfer came in at $8.0 billion. That's reasonable in isolation. The real story though is what's happening beneath the surface. The 5-day flow has basically halved from where we've been running. Tariff collections are doing the heavy lifting, bringing in $17.4 billion. Price action is reflecting that dynamic. ES futures wrapped the day at 7,444, sitting meaningfully below the 20-day moving average of 7,539. That 20-day range spans 267 points and the trajectory is downward. So you've got flows and price alignment here, both pointing in the same direction. Looking past day-to-day noise, the trend is what really matters. Government spending on a 5-day basis is averaging about $6.5 billion daily now. Stack that against the 20-day average sitting at $13.9 billion, and you've got a clear slowdown. That means less cash flowing through the system, fewer dollars reaching households and ultimately the markets. The result is financial conditions tightening up. Year-over-year spending tells a similar story. The annual figure is holding steady at $1,330.7 billion. There's no meaningful shift in fiscal support coming from that direction. Anyone thinking about taking on risk needs to account for this fiscal headwind. We're not looking at a supportive environment here. Our conditions gauge is sitting at -84, but history provides some perspective. This setup has shown up plenty of times before, and even with lighter liquidity flows, the S&P has still averaged around plus 1.5% over the following month. Markets don't track liquidity in a straight line. They grind higher more often than you'd expect. One thing to watch is current positioning. Margin debt is holding at the 100th percentile, which is elevated territory. Historically, when you see levels like that, they function more as a caution signal than anything else. Here's how this imbalance plays out in practice. With fiscal flows running beneath last year's pace, the shock absorber in the system isn't as thick. Rally days can still happen if news cooperates, but when trouble strikes, whether it's AI or tech volatility, downside moves can accelerate because there's less liquidity underneath to cushion the fall. Looking ahead, a few catalysts could shift the picture. The 31st of July brings the month-end settlement window, which affects near-term flows. Then around the 15th of August you've got the next major Treasury coupon interest payment date. Fiscal headwinds are definitely showing up in the data, though the pace of that tightening might be stabilizing. The next meaningful shift probably hinges on how those scheduled flows actually land. That's what we're watching as we head into the next trading day.